two very interesting dynamics at play there. Looking at the bond market, in October of 18, we had the most recent peak in the bond market. Since then, we've seen about 100 points come off on the bonds. We thought interest rates were finally going up. We thought the cost of capital was going up for the first time, and then we're all surprised. With what's going on globally today, we see bonds going lower. So what does that mean? It means the availability of debt is going to be abundant as we get long in the cycle. It's going to come at cheaper levels. It's going to put pressure on pricing to move up. So until the bond market reverses itself, which we just don't see in the foreseeable future, this is definitely lower and lower for longer and longer. And this is going to be an environment that's going to be very strong. It will amplify the real estate activity. And again, that will really add to the results for 2020.
So debt capital, again, for the stronger asset classes is plentiful. There are a lot of lenders and fixed income alternatives who want to get money out. So I think spreads will continue to be somewhere, depending on the asset class, in the office, retail, and industrial sector are going to be somewhere in the 150 to 180 range. What I think you could see happen in those sectors is you could see a floor as bond yields continue to go lower. I think that will scare some lenders into an all coupon rate that is just too low. So they're going to actually need to put a floor on their rates or widen the spreads. And in those three asset classes, I would suggest to you that's going to, if nothing else, fuel cap rates going lower and prices going higher because debt availability will be strong, with the exception of the Alberta market where debt availability is not that strong, especially in the office sector. But generally, right across the board, other than that, and retail enclosed malls or some troubled retail, you're going to see debt availability very strong for the remainder of the year, which means cap rates are probably going to go lower. The multifamily sector, which we're not as involved, although we're starting to get involved, interest rates, especially CMHC financed interest rates, insured interest rates are really low. And that's why I believe you're going to see cap rates continue to go lower on the multifamily space right across the board. So that's how I foresee the debt capital. And as I said, that's overall is going to mean lower cap rates for the real estate market.
Well, my view on debt is that we're seeing more and more debt flow into the market. I think we're seeing the cost of that debt continue to decrease, and I think we're seeing the restrictions around that debt in terms of covenant lessening. And so I think debt's going to continue to flow. I think equity is going to continue to flow, and as a result, I think we're going to see valuations increase. In terms of cap rates, there's room for compression, not a lot of room for compression, but I do think we're going to see, because of income growth, values going up.
I think we're in for a long period of time where we're going to have low interest rate environment. I don't think, because there's still a wall of capital that's looking to invest, I think spreads are going to continue to stay tight. And we've seen that certainly in 2019, certainly on the corporate bond market and even in the secured mortgage market. So I think that's going to be a continuation for 2020, where interest rates, in my view, will see a drop a little further. I think Bank of Canada will take action given some of the recent economic events we've seen in Canada. But I don't think loan spreads are really going to widen too much, and I think they're going to remain tight.